Companies Act. A special presentation by The Firm.
Last week on Companies Act, we discussed Chapter 3, Prospectus and Allotment of Securities.
It has widened the disclosure and levels of disclosure, enhancing transparency and accountability on the past of the company.
This chapter goes beyond intention to listing. It covers private companies. So I think those companies need to be careful anyway.
There are three broad categories where the disclosures or prospectus has become one. One is the source of fund, litigations of 5 years, and now that throws another set of issues on the table. And the third one is the as they call it, I'm just using the word, reading it actually, adverse remarks or reservations in financial statements.
Actually, I don't see the prospectus would change the way it looks.
There are two grounds on which an issuer who is in default can be prosecuted.
Those two defenses have been taken out.
If I would apply this to the various placements we do, be it private equity raise in a private company, growth capital, or a QIP, I see a lot of process bugs here.
If you come to think of it, the position that we had in the 56 Act was only worse.
This week, we continue our discussion on the key changes in corporate fundraising provisions in the Companies Act 2013, namely Chapter 4, Share Capital and Debentures, and Chapter 5, Acceptance of Deposits. Now, if Chapter 3 includes companies intending to list, then Chapter 4 expands its scope to private companies as well. When granting voting rights, Section 47 says preference shareholders can vote only on resolutions pertaining to their rights or winding up or reduction of share capital. But preference shareholders shall have the right to vote on all resolutions if dividend has not been paid for a period of 2 years. The 1956 Act explained that dividend shall be deemed to be due whether declared by the company or not. That explanation is missing in the 2013 Act. In the matter of differential rights shares, the 2013 Act imposes two new conditions. That, if variation in rights of one class of shareholders affects another class, then 75% of that other class must approve such a variation. And that a company can issue differential rights shares only if it has not defaulted on any loan or statutory payment to employees. The 2013 Act also imposes new restrictions on the use of the securities premium account and on sweat equity shares. But it's in Section 55 that the new law springs a surprise by allowing for the first time the issue of preference shares for a period exceeding 20 years. Any company engaged in the setting up of infrastructure projects can issue preference shares for an up to 30-year tenure on the condition that 10% annual redemptions will be done starting the 21st year. So this infrastructure preference share is a good one?
Yeah, it is. To some extent, the way I say it is that you have introduced EMI for infrastructure sector. After 20 years, you can pay in 10 installments the amount due. So that's how I look at it.
In fact, if you see the language, it's only more positive. It says companies engaged in setting up or dealing with infrastructure projects. So it's not only infrastructure companies. So it's actually probably some other companies, maybe like an EPC company, for example, could argue that they should be covered here.
Okay.
Only happier.
But the schedule is pretty long actually.
It is.
Longer than the income tax.
Of the stuff that is allowed to do. Yeah. Okay, great. The next positive is the fact that any contract or arrangement between two or more persons in respect of transfer of securities shall be enforceable as a contract. That's good news for call, put, and options. We now have the Companies Act, we have SEBI, and we have RBI, all three on board in differing ways, but all three on board nonetheless. This can only be a positive.
No, is it? I thought it was a grey area.
Okay. Pricing, only pricing.
Yeah,
but
so
at least the legality is now out of the enforceable. All the cases that we've seen, sort
all
of
this is
grew
tried
around
to
this.
achieve. All this has achieved is you don't need to etch your rights in the articles. Under 56 Act, it was enforceable qua the company or the other shareholders only if it is in articles.
Yeah. Right.
This has removed that need by putting it in the Act.
Yeah.
If he and I as shareholders have a contract, that is valid and enforceable under company law.
Yeah.
Still doesn't take away the need to comply with SEBI's view or FEMA.
No, of course, I get that. Of course, those are, but all those have to do more with pricing.
Like you said, the only problem probably, apart from the fact that Companies Act does speak about this being enforceable vis-a-vis the shareholders as opposed to making it very clear that the company will also be bound by such a contract. I mean, I think you would still want to have it in the article just to make sure.
The Companies Act 2013 says a company intending to do a preferential allotment of shares needs prior approval via a special resolution, and the price of such shares must be determined by a registered valuer. Note two things here: that all preferential allotments have to comply with private placement provisions, and all of this applies to private companies as well. The rules go on to define preferential allotment, excuse listed companies from needing a valuation report to determine pricing, and direct them to follow SEBI guidelines.
A couple of things. One is, of course, a valuation report. I mean, I'm not sure what they really wanted to cover, in the sense what kind of transactions they wanted to cover. Today, you can't do an IPO without having to comply with the valuer's report, because just the way the definition of preferential basis and preferential offer is within the rules, it is fairly confusing. In short, any kind of public issues by an unlisted company, which is essentially going to be an IPO, you will have to comply with the valuer's report's valuation. The Act actually almost said that the price should be determined by the valuer essentially, but the rules say on the basis of, so which gives me more comfort. The other issue here is that you should complete allotment within 12 months. Previously, the rule said that, when I say previously, I mean to say the 1956 Act rule said you should have acted upon the resolution within 12 months. So typically when we file a DRHP, it does take time for SEBI to clear. It takes at times time to even for the markets to be good enough to launch. Now you will have to keep in mind, you have to complete the allotment within 12 months. Right. It's no longer a question of whether you file a DRHP and thus sufficient for the purpose of 12 months compliance.
Okay. Okay. Any comments on preferential allotment?
Yeah, I think it's a good step in the right direction, and I think all these are anyway being done. It's nothing new. So when you do a preferential allotment, you need the view of the majority valuation.
Relatively unmoved by all the changes.
Not on the valuation, fairness
Let me get to debentures and deposits. But before that, we'll come to new conditions on the reduction of share capital, but more importantly, the changes that now seem to apply to buyback.
The Companies Act 2013 settles years of litigation regarding the distinction between reduction of capital and buyback. Section 66 deals with the reduction of share capital and says nothing in that section applies to buybacks. Section 66 also bars a company from reducing its share capital if deposit repayments or interest payments are in arrears. Creditors, the government, the registrar of companies and SEBI must be given notice of every reduction of capital scheme. They have 3 months to respond. As for buybacks, well, not much has changed in the new law, except the curtailing of frequency of such offers. The 2013 Act says no buyback offer can be made within a period of 1 year from the date of closure of the preceding offer. The 1956 Act said 365 days from the date of the preceding offer.
The two things both common to both reduction and buybacks is the non-default vis-a-vis lenders and redemption of preference shares or deposits. That's a new conditionality that has come.
Yeah, you can't do either without making sure you meet that.
Otherwise, on reduction, I'm not sure if there is any substantive change in terms of the process. In buybacks, I guess it is something, two important changes. One is reasonably clear. The period of buyback for this subsequent buyback used to be earlier 12 months from 365 days from the first offer. And if a buyback offer is valid for, say, 6 months, so the 6 months of the first buyback is included in that 12-month cooling.
Okay.
Now it says 12 months from the closure of the buyback.
So it's a longer
the periodicity of
period.
buybacks changes.
Okay.
The second, which probably is unintended and maybe it's interpretationally vague, is earlier there used to be an explicit provision in 77A of the 56 Act on the percentage of equity you could buy back.
Okay.
It was capped at 25%, in addition to the amount deployable, which is 25% of paid up capital and free reserves. Now the paid up capital and free reserves amount cap remains, but by virtue of redrafting of the proviso, I guess intentionally or otherwise, the percentage cap for equity seems to have been omitted. Yeah. So can we end up doing more than 25% in a given buyback? Is room for interpretation, but the way it's reworded, I think, gives room for doing more than 25%.
For those who are watching, you're referring, in fact, to the wording of 68
2C.
2C, right?
And the proviso
that comes
2C.
with it,
That's
right?
Right.
Yeah.
That's right.
Manan, are you reading it the same way as TV is?
I think it is possible to read it differently in the sense that, the language is not watertight, and I think that is what TV is saying.
Right.
It doesn't necessarily mean that is the intention of the document.
Of course not.
But yes, definitely
But who's going to sit and determine what the intention of the people who wrote this
there could
is?
be enforcement action. You need to be scared of that at least.
So are you still reading it as a 25% cap?
I think that seems to be the
That's what you'd
intention.
advise clients as well, TV, that don't go beyond 25%
I would
of
advise
equity.
them to go to a lawyer first.
All right.
Yeah, but
Partha?
what about this particular one which says that gaps are plugged, but it says capital reduction is governed by National Company Law Tribunal.
Yeah.
And what about that? I mean, once that comes, then you can conclude that you got a rounded thing. Till that comes, you're still in grey.
No, yeah.
Yeah.
Well.
So are we seeing it that way or differently?
Sorry, is this a question on buyback versus reduction, or
Yeah, reduction. I was just talking about reduction.
Yeah.
I was talking
So
about
I think one good thing is that there was a little bit of confusion on whether a buyback needs to follow the process of reduction of share capital under Section 100 to 104, which has been clarified now. So I think that does give a fair amount of clarity, because there was different sort of High Court was taking different views on this, but that's been taken care of. I don't think you will need to go to NCLT for that.
No, it explicitly says that
Yes.
buybacks will not be deemed as
Will not be deemed
I'm
reduction.
talking about more about capital reduction.
That's right.
That will have to go to
That's the entire idea, really. One is, of course, without going to the tribunal, and second is by going to the tribunal. And hence, you have two different sections, two different provisions.
Companies Act. A special presentation by The Firm.
Now we come to debentures. Unlike the previous law, the 2013 Act requires the issue of optionally convertible debentures to be approved by a special resolution. Secured debentures must be redeemed within 10 years, but here too, there is an infrastructure exception. A company engaged in setting up infrastructure projects may issue secured debentures for a period of up to 30 years. But the tough news is that every debenture must carry a charge on specific assets. Besides, Section 71 also requires the need to set up a debenture redemption reserve and a liquidity fund of sorts.
Partha, how do you see the developments on the debenture front?
First of all, I think some bit of good news, as I heard as I was coming here, was that NBFC's position may have been looked at very positively by MCA. So there may be some changes.
So they might get the relief, yes. The industry's been,
it's
sort
been
of
doing
agitating
and therefore let's for a moment park that and say we will come back when the final word on that comes.
Fair enough.
Yeah. On the debentures, and I think this is something that I feel quite agitated about. You said I was calm, but this one I feel a little agitated about. The good things about debenture is that you don't need trustees unless there are above 500, then only you need trustees. Shelf prospectus is another good thing, and therefore you can refresh it rather than trying to go through the entire ecosystem. And even though the class suit action is there, it brings better activism. So I don't see that as a negative, but more as a positive. The key issue is this: as an organization or as a company, we are trying to get better and more world-class standards. Now, why restrict 10 years? Why restrict, the class of times I can take? When last time, about 6 months back, we issued a 50-year non-convertible bullet repayment after 50 years. So this is defining new yield curves in the market. Now, to say that you can't issue more than 10 years.
Right.
So it restricts the development of the market. And our competitiveness will not be defined by restrictiveness. So to that extent, I see it as a retrogative step and not a positive step from a debenture point of view.
10 is what applies to all companies.
Except
only infrastructure
infrastructure.
companies can do 10 to 30.
30.
Yeah, 30.
Right?
Yeah.
We talk about
Infrastructure.
secured NCDs here, right? We're talking about secured. I think this limit of 10 years is only for secured.
It is
for
secured.
It's only
Only
for
for
secured.
secured, Unsecured can
Even the previous
be
act spoke about perpetual
untenured in that
debentures,
sense,
right? Even back in many years ago, they thought about perpetual bonds should be allowed.
Yeah, so
which the previous act did.
almost all thing works on some bit of security.
Of course.
It's pure unsecure over 10 years or something, is a
unlikely to happen.
I think the steps are progressive, especially when it comes to protecting the interests of debenture holders by way of reserving for the next 12-month period, because anything falling due within the next financial year, you have to provide for at least 50% of the amount in a redemption reserve, as well as place it in liquid bank deposits.
So they've put in
I think
safeguards.
it's a safeguard.
I think there's probably another issue that NBFCs are facing, that is about security. So what now the law says that you need to be specific about the movable property on which you will create security.
Yeah.
Now they typically used to have a floating charge on the receivables.
Yeah.
That
Now
really
there is a
is
specific
yes.
security. That's
And I think
required.
same thing in relation to immovable property as well. There is a little bit of confusion whether the property should be yours or it could be somebody else's. For example, promoter's property, for example, can be charged or could have been charged. But it doesn't seem very clear whether you could do that again or not.
Okay. There are new restrictions now on deposits as well.
The 1956 Act permitted all public companies to accept public deposits. The 2013 Act says only a public company with a net worth of not less than 100 crore rupees or a turnover of not less than 500 crore rupees can accept public deposits. A company not meeting those thresholds can accept deposits only from its members or shareholders. The term deposit has also been defined in the rules, but it's simply too long to detail here. All deposits have to be of a minimum 6-month and maximum 36-month tenure. 3-month deposits are permitted, but conditions apply. A company accepting deposits has to deposit 15% of the deposits maturing over the next 2 fiscal years in a deposit repayment reserve account. It has also to provide deposit insurance.
You know, for the smaller companies,
Yeah.
this does provide certain bit of limitation. And for the generally, there are 2 other things that come in now. One is the credit rating, and second is credit insurance.
Yeah.
Deposit insurance. Both of which will pose some bit of different kind of concerns. If you look at it overall, they are now saying that from 6 months to 3 years, which is pretty much what it was earlier, is available for all companies which have a turnover of 500 plus. So if you place the haves and have-nots, the haves have what they had earlier, plus a little bit more in terms of
3 months.
3
I guess.
months and smaller
more,
things.
sorry, yeah.
Yeah. The have-nots, the 500 and below, there is a category which needs to. But here, if you look at it a little bit more clinically, which are the ones which are defaulting most on deposits? And therefore, is there something which they looked at in the past, and based on that they made that call between small and big companies? I don't know.
From a country point of view, if it is resulting in small companies not accessing public deposits, I think it's good. Importantly, it also puts a cap on the insurance.
Yeah.
It puts
Yeah.
a 20,000 rupee cap,
Yeah.
like
On
say
the
in the US
insurance.
banking system or
Yeah.
even in India.
Yeah.
Manan, deposits?
I think they've asked everyone who's already come out with the scheme in past to wrap it up within a year's time. I think that could be tough for some people.
Yeah.
They don't really expect this to come, right?
But I thought they're not that way. I read it as companies with existing deposit need not repay within 1 year if such deposits are honored as per original terms and condition. I thought
I
that's
mean,
what
if
I
you see
said.
74(1)(b), it says repay within 1 year from commencement of, or from the date on which such payments are due, whichever is earlier.
I think we need to look at that in time. I
Yeah.
need to.
So it's 1 year.
So I mean, a lawyer is always right. So, but we,
Oh, you can't ignore the lawyer.
yeah,
yes.
yeah.
Essentially
Or the
these
law.
or the law. These 3 chapters
is
are
easy.
the fundraising, aspect of this Companies Act, and I'd like your last thoughts on where we've reached. This was a law that was supposed to deliver to us a more modern architecture. Has it not? Has it made some aspects of the law so onerous that it's almost impossible to meet with it?
I had 2 comments when I presented to the senior management. One comment was, is it an angel or Frankenstein? And the other comment was, is it a bird, is it a plane, or is it Superman?
Let me ask you the question. Is it an angel or a Frankenstein, Partha?
Somewhere in between.
Is it
No,
a
no, there
bird,
are
is it a plane, or is it
It's
Superman?
It's trying to be a little bit of the Superman. We are doing the modern architecture. I think they've done all the right things in terms of steps, and they've considered. The implementation and the administrative ones, which is still to be crossed, which TV brought out, let's say, in the earlier part of our conversations, will be very, very important, and how SEBI and other agencies kind of come along with it, and as we taste the first few cases. Yeah, we are comfortable with 1956 big act because we know what we can expect out of it.
There is so much precedent in it already, right?
But
So
this is going to be tested. So
that said, Manan, do you think we've moved a step forward?
I mean, I think yes. The act per se was just I mean, far better than the previous one, for sure.
Far better.
Yes, I think the problems were also coming from the draft rules. Lots of them have been sorted. The way I still see is, I think the listed companies probably will find it easier to deal with it as opposed to the unlisted companies.
Yeah.
Because it does mean to kind of bring in the SEBI regulations for unlisted companies. For example, buyback. And many other regulations where you would expect unlisted companies not to be expecting to be complying with them.
But they now have to.
But they
because
now
if they're
have to,
public,
yeah. And, you would almost think the SEBI written this act.
Yeah. In fact, I think that's a comment that comes up recurringly every time we discuss this act, is the inclusion of public companies, unlisted, as well as private companies in several aspects of this act where they were not included in the previous act. That aside, TV, how would you assess these three chapters?
I tend to take a radical view on the appropriateness of dragging in private companies also into this. What has this act achieved? It has achieved a certain norm for governance, a certain norm for disclosures, and a certain penalty for non-compliance. I think that's the broad objective here. If you look at the country's evolution and issues that we have seen around corporate India and abuse of law, etc., perhaps the time had come to bring in to the fold of a well-regulated fold even private limited companies. Okay. Now, what is the cost of the compliance? Not every company does buybacks every day in and day out. Not every company ends up raising monies by preferential issue.
Sure.
So some of these are more one-off matters. But by bringing them within the ambit of a forward-looking act, I think it has made some of the issues we have faced around broader corporate India on abuse of
the
corporate
governance
structure, I think is good for the country.
Okay. That's on the inclusion of private companies.
Absolutely.
A quick last 10-second comment on what this means for fundraising for India Inc.
As Partha said, and I always have believed, in a developing, evolving country like ours, all said and done, our stock market, well-regulated stock market, is all of 20 years old in this country. SEBI itself was formed in 92, right? So each time the regulator tries to play catch-up, there will be a certain set of developments on behavior which may be ahead or behind the curve. So you will face an evolving regulation. It is for intermediaries and corporates to acknowledge we will have an evolving regulation. There will be slips and falls and ambiguities. So long as the intentions are understood and regulator is sort of cooperative and progressive in resolving ambiguities, I think this is a very good development.
On that partly fatalistic note, gentlemen, to all three of you, thank you very much for joining us on this edition of Companies Act. Next week, here's what you can expect from us.
Companies Act, a special presentation by The Firm.